right? And so he has 25 years of funds and investment banking experience with private equity mergers and acquisitions across the world. And he has 10 years of experience of managing a portfolio of companies across 20 countries where we have our own presence. Well, George has built companies into multi-billionaire, billion-dollar companies, okay, and has graduated from, as I told you, Oxford and Harvard, and brought a new perspective to companies' growth through his QY model of multi-company governance. Study 360 takeover are also some of his models which he has built. Okay. He is an industry speaker and has addressed the Euro Summit, World Startup Expo, and several global forums. And he has won variety of awards, social awards as well from WHO, UNICEF, for his anti-tobacco activities, widow education, orphan education, and he's actively involved in a lot of charity and philanthropy programs. So, looking forward to listening to this amazing personality. Even I am looking forward, and welcome aboard, all of you, and welcome, George, and over to you. Thank you so much.
Good morning, everyone from the US, and good evening to everyone from India. Thank you, Nikhil. I look forward to having a wonderful session with you this morning on how do we actually globalize our companies. I've been, looking at multiple. I've been working in this field for the last 20 years. We have helped companies go from US to Europe, US to Asia, then Asia to Europe, Asia to US, and then also into the African markets and Latin American markets. So I'm just going to give you a couple of ideas and hints, and what mistakes to avoid, what not to avoid. So there we go. So is global marketing really hard? Is it really hard? If it's so hard, then if it is easy, then everybody would have built $1 billion empires. But if they are not doing it in the right way, then you're struggling. And if you're struggling, then this is for you. Because if you're doing it the right way, you would have taken your company to multiple geographies, multiple product locations, multiple products, and scaled up your operations into a global GE or Ford or any of those companies. So how do we develop global markets? What are the simple steps for successful execution? What do we need to do to execute correctly? And then something that I've learned from my Harvard education is, how do you measure life? How do you make sure that you don't take steps to fail? I mean, these are some things that I want to share about. So when we're looking at global growth, I just wanted to look at 2-3 companies and see what these companies did right and what these companies did wrong. I mean, so you can understand from a strategy perspective how this whole thing's coming into play. So I'm looking at, Nike versus Reebok. In 1984, Nike and Reebok, 1980s, Nike and Reebok had about $100 million operating profit, and they were both on the same platform. Then Nike realized, listen, why don't, we're just running into running shoes. Can we get into a different product category? So Nike said, let's get into tennis. And they signed up John McEnroe in 1984. And that was a huge success. And then Nike said, you know what? We got tennis shoes, so can we get into soccer, and can we get into other, because they have already gone through the learning curve of one shoe, how to get into one model and do it very well. And meanwhile, they also started expanding geographically in multiple places across the world. And by 2000, so then Reebok started catching up. Reebok said, you know what, we are not going to get into following Nike in the Nike's path, but let's do something else. And so Reebok went and said, we are a high-end sports company, and they went and acquired a boating company in New York. And by 2000, Nike had an operating profit of $1.1 billion, and Reebok, from 100 million, it just went to 124 million. Two companies started saying, one went to 1.1 billion and the other one was struggling. What happened? It's a strategy. It's a strategy. So Nike, went on to expand globally, and Nike realized that if you're coming into a Nike showroom, then, you might as well get into, clothing and the rest of the sports apparels. And so that's how Nike, ran away to a global success. Let's look at another company. ST Micro. I'm running short of time, so all my cases are going to be very short, but we could get into a lengthy discussion later if time permits. So ST Micro was a small company, following Nokia in 1980s, and they were a supplier to Nokia. So ST Micro realized, how do you actually grow into a large company? They said only one strategy, that is follow your customer. If you have a customer who is global, just follow him, because if you follow your customer, you reach a global level. ST Micro, wherever Nokia went, they went, followed up, and set up a small operation supporting Nokia. And wherever Nokia went, all the other cell phone manufacturers like Ericsson and everybody else set up shop close by. And so ST Micro not only started supporting Nokia, but also the other players in the field. And today, ST Micro is a multi-billion dollar company. Look at another company, Star TV. In 1990s, Robert Murdoch, our owner of Fox TV and all that, they realized, listen, there's an elite middle class coming up in India and South Asia. So we'll have Star TV as a special brand that will go and give a rich lifestyle for the elite class, and they will get advertising revenues, and let's do that. They didn't understand the culture. They didn't understand everything. They said, you know what, there is a middle class, the upper middle class, we just target them and Star TV. And some of you from India will realize Star TV was there in 1990s, 2000, 2004, 2005. It was a hit, but financially it was a disaster. They lost money, about 114 million in 2000 and about 145 million by end of 2010. And they had to really, realign themselves. So what we are seeing is you need to have the right strategy. And that is very, very, very critical. The second point here is understanding global culture. So this chart is from Harvard Business School, the magazine that I just pulled up just for this meeting. You see, if you look at this chart here, towards the left, you see the points that we are showing is that caring, purpose, learning, enjoyment, results, authority, safety, and order. That's the chart of how this entire global culture has been divided. So if you look at Africa, the caring is pretty high. The people there care for each other. But if you look at America or the Western organization or North America, you'll see that it's somewhere about 37%. The difference is not huge, but it makes a huge impact. When you go into Africa, you are getting into a different culture, whereas in North America, it's much more cold. And if you look at, United Kingdom and other areas, it's a little more colder. But if you go right to the bottom, order, right? You see the Western countries are high in order and systems and processes, whereas the order is very low in the in Asia and Africa and these countries. You go down to safety standards, the safety standards are much lower than what you see in the Western countries. So this is something, they look at. And also results. Look at results. Results are much lower when it comes to Asia. Asia has got 26 points here at results, whereas in the Western world, it's somewhere like 33% and 32% in that range. So North America is 33 and Asia is 26. So that's how the difference is. So if you take the wrong culture in order to get into a market, then you make mistakes, and then you have to adapt to that thing. So we have seen companies fail because they have not been able to adapt to the local cultures and this thing there. Next is, the strategy. So when we come back to the strategy, let's look at, okay, now you're a company, you are a mid-sized company, $50 million, $10 million, $5 million, $500 million. You want to go into a new market. And I'm going to give you an example. I was approached by a $120 million company in Illinois. They are predominantly selling in the US market, and they wanted to go into a global market. They wanted to expand their products because they have the latest technology. They're market leaders in North America. And they just said, can we go into the rest of the world and sell our products? And we said, of course you can. But what is the strategy? Do you do it directly from US, or do you appoint distributors across the world, or do you get into strategic alliances in certain countries, or do you do joint ventures in few, or do you do an acquisition in one or two countries, joint ventures in two, alliances in third, distributors in four, and somewhere direct, or you just outsource this to somebody else? There's another way. There's a company from China who approached us and said, listen, we want to expand our operations into the US market and European market. How do we do it? Do we appoint distributors? Do we acquire? Do we get into a joint venture? So this is a challenge all the time. And there is no unique answer for any particular company. You need a hybrid model. So when I'm speaking with CEOs of companies and I'm talking to them and telling them, listen, what's your strategy? And they say, well, we have, our traditional model in the US is like a distributorship, or our traditional model in India is like, we approach our customers directly. And I think that will work for us in the US, or that will work for us in Europe. I'm sorry, it's not going to work. Each market has its own method of approach, and you need to have the right strategy element, because you need to look at how the local people do that. And if the local people are predominantly not relationship oriented, say Japanese are more relationship oriented, whereas North America, it's much more, it's buy and sell, it's plain on the merits. So that is one. Getting your strategy right is very, very, very critical. And I've seen in situations in companies across the world where the strategy element comes in, we are seeing that you get it wrong. For example, we had a company by name of Osimam. Now, Osimam was a company in India, Bangalore, and they were in biogenetics sourcing, and they grew up so rapidly. I mean, so what they did is they did two acquisitions in Europe. They got $1 billion, $2 billion, multiple valuation, but then they collapsed because the strategic, plan of acquisitions went wrong. Whereas companies have grown step by step. Look at Coke. In 1918, Coke said, it was World War I. Coke said, if Americans can drink Coke, can anybody else drink Coke? So first they went to Canada in 1908, then 1914, they went to Mexico. And then Coke realized, if North America can drink Coke, can the rest of the world drink? So 1920s, they went to Europe. Today, Coke is in more than 140 countries, and 70% of Coke's income is from the rest of the world. Only 30% of the income is from the US. So what we are saying is we have to get the strategy right. And if you get the strategy right, you will soar the skies. And we have seen companies who got the strategy right, soaring the skies. There's another company, I can case studies. It's a smaller company, about $50 million, came to us. And this company came and told us, listen, we like to see if we can grow to be $1 billion enterprise. We set up, two ventures for them in Germany. Then we acquired for, two European companies in Germany. Then two European companies. Then we went and acquired a Thai company in Thailand. Then, did a joint venture in Hello. So come out and tell me what you want to eat at this late night. Come out and tell me. Nikhil.
Yeah. Guys, please unmute everybody.
Please mute everybody.
Yeah. Oh, sorry, mute. I'm so sorry.
Yeah. So the strategy, it has to be very, very clear in terms of how do we do it and how do we go about doing this. So this is very, very critical about the strategy element. And, second is global customer mapping. So I've seen numerous companies, every company who wants to go in and set up global operations, either to sell into North American market or European market, or outsource from those markets, or get into Asian markets or African markets or Middle East markets. The first step after strategy is to do your global customer mapping. You fail to do this step, then you're doing a shotgun approach. If you're doing a shotgun approach, you're just going around without a global strategy. You need to have a shotgun approach. And this is you should not have a shotgun approach, because a shotgun approach is you're blasting all over the place and thinking that something's going to work. No, you need to map your global customers. You have to find out who they are, how they are buying, at what prices they are buying, and what quality they are buying. Can you supply that quality? Can you supply to them at that level? What is it that they're doing? What are their payment cycles? What are their preferences? Who in the customer is actually making the buying decision? How are you doing it? This global customer mapping, the customer density. You come to a country like America, where exactly are your customers? Are they in Chicago? Are they based in Florida? Are they based in Texas? Are they based in Illinois? Where do you think? If you're going to Canada, if you're going to Germany, if you're going to Norway, where exactly are your customers? How are they concentrated? What are their buying preferences? Who does the buy? I mean, this is something that you have to do before you get into a global marketing strategy. If you don't do it, I've seen companies after companies struggle and struggle and struggle after 3 years, 4 years. There's a company that I know, in Kuala Lumpur, making medical devices, and they wanted to export their products. So they went on an exhibition to Germany, went an exhibition to US, exhibition to Middle East, and they went spend a lot of money and time on exhibitions. And they said, okay, exhibitions are going to give us relationships and we can develop on them. But remember, exhibitions, you go to exhibitions, somebody comes to exhibition, that's a very, very, 5% of the market that you're trying to reach out to. There is 95% that you're not reaching out to. Some of them are so big, they don't care. Some of them are so small that they don't know, they don't want to do it. Some of them don't have the times, they don't come inside. You have to invest in global customer mapping. That is so critical. If you don't invest in global customer mapping, this company in Kuala Lumpur went and spent 3 years, 4 years. There was another competitor of theirs who had grown up to 7 times by this time. And when I was in Kuala Lumpur, in Malaysia, this gentleman comes and meets me and he says, I've been trying to do this, and what is it that I'm doing wrong? And we just asked him, so how do you sell? And he said, I go through exhibitions, I go do this, and I, try to. No, we said, no, that's not the way to do it. You need to know, if you're looking at Germany or you're looking at, United States, who are your 100 top customers? What are they doing? How are they buying? Whom are they buying from? Can you support it? Do you have warehouse? Do you have inventories? Do you do this? Do you do that? And what are their preferences? Will they buy from an extra? I mean, there's so many things that they're looking into. You want to enter, a company like, market like India, or you want to enter this one? How do you send from US? Do you do manufacture locally? How do you actually sell into the local market? What are you going to do? You have to do your local global customer mapping. This is so critical. Without that, it's a big, big waste of time and effort. And you realize it 3 years later, 4 years later. 4 years later, competition has moved ahead. The third important point that is to look at, dedicated focus and investment. I'm seeing companies after companies look into operations and then say that, well, you know what? How do I get into dedicated, investments? Dedicated investments are really very, very critical, because dedicated focus and investments. Customer mapping will cost you somewhere between $10,000 to $60,000 to $100,000, depending on how many countries you want to actually get it done. But customer mapping is only is like a roadmap. It's not going to take you there. You need to have staff. You need to have people who will invest resources daily and who are able to reach out to those people directly and keep pounding till the wall breaks. And that is how you get that access. You need to reach out. You need to have focused approach. Making a phone call and then expecting them to return the call is not going to work. Sending an email and expecting them to return that email is not going to work. 90% of the time the mail goes into spam, or even if they read it, it doesn't strike them. They think some foreign company or whatever it is. If you want to do it, you have to do it right. It needs dedicated time, dedicated focus, and investment. And tenacity. Without that, it's not going to, if you want to do global marketing, it's not going to work. Now the question is, let's just look at, direct remote sales or distributorship. So we have three, four things: a strategic alliance, remote sales, joint ventures, and all that. So there are companies who want to just get into remote sales and distributorship, and we have seen this in so many types of industry, like packaging industry. So they get into, have a website, they generate inquiries, and companies in Italy do this, most of it by remote sales and distributorship. They don't go and set up bases in other places. This will yield results, but it will yield 5%, 7% results. It's not going to take and double your turnover. It's not going to increase your shareholder value by 5 times and 7 times. This is like if you got, $10 million sales, you could add another 2 million, 3 million. If you got 100 million, you'll add another, 5 million, 10 million. So that is how distributorship works. It works, but it's not going to double and triple your revenues or your shareholder value. Strategic alliance. Companies from distributorship, they've gone to the next step of getting into strategic alliance. And I've seen strategic alliances are, not a formal joint venture, but loose bound. I bring this to the table, you bring this to the table. We are not bound, but let's see if our alliance works. It does work basically if you're taking a license and royalty. So you're paying, you got some technology, you want to distribute your technology into some South Asian market. Somebody's paying you a license fee and a royalty for it. That's fine. That model works very well if that's a model that is the right model for you. But if somebody's going into a market to sell, their local partner is making the sales and you're bringing in the products, that also works, because that is another way to actually drive this entire thing forward. So you're able to drive this in a model where you're able to get into a partnership, you're getting into a strategic alliance, and you're able to do this. It's also, for you to enter the waters and test the waters. Is this model going to work before you invest too much time and effort, setting up a joint venture or acquiring or setting up your direct presence of in the marketing, in the field. So that is how you're looking at it. That's how you're driving it, and that's how you're pushing this forward. Now, if you go forward and look at how this distributorship and the model strategic alliance works. One is, there are 3 ground principles that you have to do for strategic alliance. The first is you have to be open and transparent about what your roles and responsibilities will be in an alliance, because this is built on trust. This is not built on documentation. And let me remind you, even if you have the best contracts fail. You have to look at the people and finally see if people actually work. So that is very, very, very key, to make sure that the people actually work. The second, big aspect out here is to make sure that you are able to drive this with some sort of a business plan. Because if you get into a relationship with somebody on a business without a formal business plan in terms of projections, in terms of expenses, in terms of who does what and how you will also resolve it, because you don't get into a strategic alliance without also defining, in case a relationship doesn't work, how do you get out? And that is very, 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 very critical, because things. So defining, being transparent, financial plan and business plan, and third is also defining how you will plan to exit out in case you think. If you're able to do that, this is a great way to get inside without too much investment, but also testing the waters to see if it actually works. Now, I'm moving on to the next slide. My screen is moving. Yeah, so then we're going on to the next one is joint ventures. How can we drive this value? For me, so you're looking at getting into a partnership with somebody, investing time and getting into a market. This is something that you can always keep trying, because joint ventures is something that's going to drive your entire results forward, and it's going to take you to the next step of how this is going to work. Joint ventures is only if you are looking at entering a country, but you don't have the marketing power, or you don't have the local resources, and the local partner is able to bring the local resources. If you want to sell in the market, the second type of joint global joint ventures is where you bring something to the table. You're in a country like India, or you're in a country like China, Malaysia, Thailand, Vietnam, all these low-cost manufacturing countries. So what you do is you are able to partner with somebody, and introduce your products into the other market, but also support them with low-cost manufacturing and introduce their products in a reciprocal synergy. So that's why you have modular synergy, sequential synergy, and reciprocal synergy. And we have seen time and time again that how this entire thing works. Now, joint ventures over the last 5 years, last 7 years, there are about 5,000 joint ventures that was declared across multiple countries, multiple places. But we have seen only about 20% of them succeed, and the rest of them fizzled out. It is very important that you understand that when you get into a joint venture, you have to either the joint venture performs, and if it doesn't perform in the first 2 years, then it's going to fizzle out. So it needs time and investment to make it work. And if it will only work if there's a reciprocal synergy as well. Everybody looks at joint ventures only from a modular and sequential. Modular means, a structure and everything is great. We bring this, you bring this, and these are responsibilities. But sequential is, if I do this, then you do this, and then what happens? So you're looking at sequential synergies. And reciprocal is, what more can I support you, and how much more can I support you, and how do I do this forward? We have case studies of multiple companies who have done this time and time again. And I'm looking at, how, Nestle did a joint venture, and they had great success. Ford did a joint venture, and after some time, Ford had to just say that this venture is not succeeding, and they had to get out. So it's not the size of the company, it's not the depth of the company, it's the modularity, the sequential part of it, and the reciprocal part of it. And I've seen companies actually grow very, very well out of this thing. One of them is the, we have Anurang Jain and Tarang Jain. Both these brothers have built both those companies into a phenomenal billion-dollar enterprises just by acquisitions and joint ventures and getting into different markets. So some of the JV challenges that we see are strategy, governance, economics, and organization. So these are the four different problems that we see in joint ventures, and there are solutions to make each of them work. For example, for strategy element, you have to align the parents' interest right. For governance, you have to apply loose and tight governance. You just cannot be either loose or tight. You need a fix of both. This thing. Economics, you need to specify the parents will provide and establish fair transfer pricing schemes. Joint ventures should have fair, transparent pricing schemes. If it is not fair, it'll collapse over a period of time. It's like a marriage. In a marriage, if the spouse feels that he's not, then he gets a divorce. So the wife feels that he's not getting a fair treatment, the wife gets a divorce. So it's a fair transfer pricing scheme that has to be done. And organization, secure commitments from key staff, because you need to have the staff to run it. Those are the people who are going to create the joint venture and make it work. Unless they are committed, it's not going to work. So these are from the joint venture perspective. Now we're looking at acquisitions. Companies have grown and gone into new markets through acquisitions. How have they gone through acquisitions? You look at an acquisition and you don't say, oh, you know what, this acquisition is at this level for me. I think, I cannot acquire a company that is 2 times my size or 5 times my size. I have to acquire companies I can acquire a company that's 2 times or 3 times my size. We have done several types of acquisitions. We have done acquisition of and currently we are doing acquisitions for companies. We are acquiring into Europe, we are acquiring into Asia, we are acquiring in North America, we are acquiring in Africa, we are acquiring all over the world right now for companies. And acquisitions funding is also an important aspect. And when you're looking at acquisition funding, funding is always available for acquisitions, and it is very, very, very clear intent that funding. If you have 10% of the margin money that is required, the rest of the money can be arranged through so many sources for an acquisition into the market. So one of the two aspects of what I wanted to tell you was about the Tata acquisition of Chorus and the Tata acquisition of Jaguar. Tata acquisition of Chorus. Chorus is a large steel manufacturing firm in United Kingdom. Tata is one of the largest conglomerate in India, and they're also into steel manufacturing. So when Tata wanted to acquire Chorus, which is more than twice its size, they still went ahead and did it by buying off the debt and doing it. But finally, Tata's output post acquisition from 18 million metric tons came down to 10 million metric tons, because the acquisition was not planned and it did not hit the synergy goals. Whereas Tata went and acquired Jaguar, JLR. JLR was bleeding, and Ford was owning JLR, Jaguar Land Rover, and Tata's went and said, listen, let's buy JLR. And it was bleeding $1 billion. $1 billion was the bleed per year. And when Tata's went and acquired JLR, the management at JLR said, you guys are from India coming to acquire a British premium luxury brand. You are selling a $1,000 car in India, and now you want to, acquire a $40,000-$50,000 car company. I mean, how are you going to manage it? Do you think, we're just going to shave off the prices? So Tata's, in 1 year, they changed that loss-making company into $1 billion profit-making company in the same year. They replaced all the top management. They got the second and third round management with the guys with fresh ideas, went to the customers, followed the customers, and did the entire turnaround. So what am I trying to say here? I'm saying that your acquisition strategy has to be aligned with your capabilities and things. The same Tatas did one right and did one wrong. So what we are saying here is you can acquire, you can do it with low cost, but it has to be aligned with your first strategy. What is right for your business, and how do you scale up your company so you can have 2 times, 3 times, 4 times revenue over the next 5 years? Is it possible? Yes, it's possible. How is it possible? It can be done. And we have seen another acquisition where Intel paid 1.6 billion in cash for DSP communications, and that they lost 700 million within the first 2 years, and they had to sell off the company. So whether it's large company or small company, your acquisition strategy has to be right, and if it's rightly aligned, and we have helped several companies for acquisitions across the world. We have done it over and over, so we know what to look for and what not to look for. So what is your plan for the next 3 months if you want to execute and reach a foreign market? Say you're sitting in Kuala Lumpur, or you're sitting in Sri Lanka, Colombo in Sri Lanka, or sitting in Mumbai, India, or you are in London, United Kingdom, or you're sitting here in Chicago, or Cleveland, Ohio. How do you actually get into this new market? So first is go through your strategy exercise, and this is a 2-week exercise to understand what is the right thing. And if you know it, that's perfect. If you don't know, that's the thing. The next step is the global customer mapping. This is going to take about 3 weeks or so. So in a month, you should have finished your strategy and your global customer mapping. And that is that's going to support you and take it through. After that, you have your identification of your target customers. This is a critical aspect. You need to know who the CEO is, what are his contacts. You need to know who the strategic officer there is, purchasing. I mean, whatever, who is the type of customer, you need to know all of them. And that identification is going to take about 2 to 3 weeks. Reach out is about another 2 weeks. So once you have identified, met with a few of them, then you start your meet and pitch. And your meet and pitch is today, before global marketing was difficult because you had to go in person and meet and pitch. Today is just a Zoom call, and once they agree, everybody agrees, you get into a Zoom call, you at least get to see a face, you get to ask the questions, there's a live meeting, everything happens over there. And if there is a value that can be created for both companies, you have a letter of intent, you have a business plan, and you have an agreement, all done within a couple of weeks. And so you are able to go into a new market and launch your products successfully, whether you're entering the Asian market, or you're entering the Middle East market, or you're entering the European market, or you are coming back and entering the US market. There's a process. This is a simple process that we have seen. You need to have dedicated time, dedicated resources, and able people who are able to execute this. So that's what I was going to talk to you about on this thing. But also, I want to jump back onto the, my original thing that I learned from Harvard is, do any of us plan for failure? None of us plan for failure. So then how do we fail? Why is it that we fail? So are they man-made, or are they this time? I mean, is it some destiny that I'm bound to fail? Or are we doing mistakes right now that is going to make us a failure? Failure in business is well documented and something that you need to look at. For example, in 2000, the CEO of BlackBerry, he didn't go and tell his company. BlackBerry was a smartphone, one of the global market leaders before Apple. And everybody wanted a BlackBerry because you got instant emails on your devices. That's very secure. And he was like the king of the mobile phone. And did he go to the board and say, ladies and gentlemen, in 10 years from now, we'll be bankrupt? But in 10 years, in 2013, the company declared bankruptcy. So what happened? He had the best resources in the world. He had the best people in the world. He had the best alums, Harvard graduates in the world. What happened? Nokia, one of the largest companies in the world, in 2004, did he go back to the board and say, ladies and gentlemen, in another 10 years, we'll be bankrupt? So what exactly went wrong? How did they do this? And what went wrong? So you can read through this in the book by How Will You Measure Life? But I will tell you a very simple answer to this. What Clay Christensen had said was, you have to invest short-term and long-term. If you don't invest short-term, it will not succeed. If you invest long-term, it will succeed. So if you have to do, but you need investing in short term and long term. For example, if you don't invest in your spouse now, you will have a divorce. If you don't invest in your children now, you will have your kids not succeeding later in life. You have to invest in your business, but also you have to invest long term in what's your long term goals in your business. So global marketing, global customers is a long term strategy that has to be invested today, because you just can't depend only on your market, because there is a time when one market may have a recession, the other market may not be having a recession. And that's how you mitigate the business risk, by having both the markets. And you need to invest short term and long term. Success is what people think is an overnight success. Companies who have reached $1 billion sales, $500 million sales, everybody says, wow, that's a great success. No, it was not a great success. They had to go through lots of lot of learning curves, lots of failures, how they grew up, and that's how they reach their final success. So here we are. So in summary, I have to tell you, get your strategy right. That's the first thing. The second one is complete global customer mapping. That's so critical. Third is you have to identify these companies and reach out. Reaching out is just not by email and by a phone call. It just doesn't work. Fourth is you have to meet, pitch, and focus on getting them to commit themselves by writing a letter of intent, develop a business plan, finalize the agreement, then soar the skies and conquer the world. Thank you. And thank you to my team for setting this webinar up. And thank you to Mark Fraser, my Harvard buddy, who put this presentation up for me. And thank you for joining joining the meeting. So thank you all. And these are my contacts.
Thank you so much, George, for this wonderful session. We have a question which is really important from one of the social media platforms that how do we decide the right market to enter and how can Alcor help us?
So deciding the right market to enter is where you get through your global customer mapping. Because once you do your global customer mapping, you will immediately find out your global customer density, which market has your maximum global customer density versus for your products, your services, your ability, and also which region also is a high paying customer. So if you find that out, that's where you focus on. Sometimes it is Europe, sometimes it's North America, sometimes it is Middle East, sometimes it is depending on your products, your customers, your services. So that's the first thing. Alcor has, his investment bank offices in multiple countries. We'll be there to look at it or work with you and do your global customer mapping. We'll also do a global strategy review and see, what is right for you, whether it's just direct sales or whether it's distributorship, whether it's joint venture, whether it's an acquisition. And then we have a team that can help you execute the whole process. So you don't have to invest too much of your time, but we'll be able to take it and go through step by executing it for you.
Thank you so much, George. And I think we have already all right. So I think we have got no, there's no question. So, all right. Thank you so much, all of you, once again. And if you guys have missed out on any questions, just in case, please do send us an email. Okay, you can reach out to me or anybody from Alcor, and you have George's contacts right here. So please reach out, and we will be more than glad to assist you. Thank you so much, George, once again for a wonderful session, and thank you so much all for joining us. Okay. Until next time. Thank you.
Thank you very much. Thank you, and thank you for joining. Feel free to reach out to us. We'll be definitely be there to listen to you, help you out, and we can go into each of your companies to see how we can help you and take you through. Thank you.